Our third theme surrounding global equities is it's important to remember from an investment standpoint that the stock market is not necessarily the economy. We've outlined how we think that the U.S. economic expansion can continue. Again, it's a math problem. But when it comes to investing, that math is not always as black and white. There's a lot of gray area. And I think we've seen this in the past couple years where momentum has really taken over all fundamental analysis. And what we've seen with that is across a variety of different global indices. You can look at this table, the Russell 1000, which is the US index, the MSCI EAFE, which is the developed international index, the MSCI Emerging Markets, looking at a variety of different valuation metrics. All of these are trading at very steep premiums compared to their historical average. So it really does justify a very close look at your global equity allocation. We're entering 2026 actually underweight global equities, which is a big contrarian view. We have seen these markets run way too hot, way too far, way too fast, and they're pricing in the rosiest picture from a growth perspective as well as an interest rate perspective. And we're very concerned that there may be some shock when investors realize that the central banks cannot be as accommodative as the futures markets pricing in. Now, some of the themes that we see going on this year is that quality over momentum trade. So focusing on those areas of the equity market which have solid, steady earnings growth, not necessarily the hot flying momentum type of stock that really trades off of trends from an investment standpoint. These things, this rotation will continue to shift. We saw it towards the end of last year, and we're going to see it again this year. We don't think there's a whole lot of PE expansion for this coming year. We've seen this in the past couple years, and when you look at this chart, it's showing you that the rolling 3-year PE expansion for the S&P 500 is at the highest level we've seen since the dot-com bubble. And this is just pricing in that perfection. We don't think that this is sustainable. Instead, it's going to have a lot to do with earnings growth. The earnings expectation is for mid-double digits from an earnings growth perspective for U.S. equities this year. We think that's a little bit too optimistic, especially since it's completely concentrated in tech. And eventually, all of this AI spending that has boosted earnings, investors will be looking for that to be translated into earnings. And we think this year and next year, it's going to be a challenge for these companies to deliver. From the global standpoint, we do think there's some opportunities, though. It's just you have to be very selective. While developed international equities did outperform the U.S. last year, you have to remember they're still underperforming from a long-term perspective. And when you look at this chart, you can see both the MSCI EAFE and the MSCI Emerging Markets. Their valuations, they're trading at historical discounts, not only from a valuation perspective, but from a price perspective compared to the U.S. So if you have no allocation there, it's not too late. Make sure you have some allocation there. But as a whole, from a global equity standpoint, we would be underweight to the benchmark coming into this year. Having that dry powder, we think there'll be opportunities, but also utilizing hedging strategies. So that way, if there continues to be this momentum trade or this euphoria, that you can still benefit from that. And remember, stock markets can stay overbought for significant periods of time. They can also stay oversold for significant periods of time. We're looking for that period where some of these valuations come down and give us that risk reward potential we're looking for.